Welcome to my channel. I'm Scott, and if you want to catch my newest video, I post one every day at 8 a.m. In this video, I am going to walk you through the process of valuing ATIF Holdings stock by analyzing their financial statements and dissecting their financial ratios, so we can determine if it's a buy or a sell. ATIF Holdings is a holding company located in China. Its subsidiaries provide financial planning and investment advisory services to small and medium-sized businesses. It offers asset allocation, financial management, training, and capital restructuring. Let's get started with the model. This is a micro-cap company, 54 million market cap. They're trading at 106 a share, and they have 51 million shares outstanding. Let's look at the financials. The way you value a company is you forecast the free cash flows into the future, and then you discount that number back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doesn't look so good. It was positive in 2017 and 18, but negative in 2019 and the trailing 12 months. Net income is the profit and loss on the income statement. It's revenue minus expenses. And they do have positive net income in 3 of the 4 years, negative in the trailing 12 months. Their revenue doesn't look so great. It's $4 million in 2017, up to $5 million, but then it drops in 2019 in the trailing 12 months. This is the company's income statement. The top line is the revenue, the sales for the company. Below that is operating expenses. And then when you take the revenue minus operating expenses, you have your operating income. And that was negative in the trailing 12 months. It was positive in prior years. The company has a small amount of other income and expenses. Of course, they have to pay taxes each year, and the bottom line of the income statement is their net income. It was negative $3.8 million in trailing 12 months, but it was positive in prior years. Their sales are probably a lot lower due to COVID, because lots of small and medium businesses are cutting expenses, so they're probably not doing business with companies like this. This is their statement of cash flows. The top line is operating cash flow, and they had negative operating cash flow in the last 2 years. Then you have capital expenditures, which are investments in property, plant, and equipment. And the way you calculate free cash flow, it's operating cash flow minus CapEx. So you can see the company didn't issue any debt. They have no debt. They did need to issue $8.8 million of capital stock. That's because they were operating with negative cash flow, so they needed money from somewhere to run the business. Let's look at a capital structure. They have $11 million of equity and no debt. And their WACC is 13.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated terminal value, which is all cash flows past year 4, that's $96 million. We discounted those numbers back to today's no weighted average cost of capital. We get a value of the company of $67 million. We divide that by 51 million shares, and we get a calculated stock price of $1.31. They're trading at 106, so they're trading at a 19% discount. It's a buy according to the model. It's hard to forecast future free cash flows for a company that has negatives in there, and also they don't have much revenue coming in. So I looked at the growth of similar companies, and I also took into account they're struggling due to COVID, but when the pandemic passes and things get back to normal, I think they'll start bringing in a lot more revenue. Of course, any valuation into the future is a guess. Nobody really knows the future. We're just using the information we have now to try to figure it out. It looks like the stock was trading over $5, but it just keeps coming down lower and lower, and it's at a pretty low point. This is what the stock looked like the past 5 days, so you can see it doubled in price yesterday. It has come down from its peak, but it's only been 1 day. I'll explain why the stock went up so much yesterday. There's a company called Century. They lease aircraft engines to regional air carriers, and their stock went up 1,300% on Monday, which was yesterday, the 28th. ATIF owns 6.6% of Century. ATIF paid $284,000 for the stake in Century. That's 101,000 shares at $2.80 each. ATIF's 101,000 shares are now worth $3.85 million. So ATIF could turn around and sell their shares and use the cash to grow their business. If you invested $10,000 into ATIF in 2019 when it started trading in the United States, you'd have $1,400 today. ATIF stock has gone down 67%, which is much worse than the S&P 500, which went up 15% in the same time frame. Their 52-week low was 65 cents, and the 52-week high was $3.75. The stock is trading above its 50-day moving average, but below its 200-day moving average. When the 200-day moving average crosses above the 50-day moving average, that's called the death cross. That's a bearish signal. And the stock has a pretty low trading volume, about 600,000 to 1 million shares are traded each day. It also has a really low float percentage. Of the 51 million shares outstanding, only 10 million are on float. The lower the float percentage, the less liquid the stock is and the more volatile. A majority of the shares are held by insiders, probably the people who started the company, and only 0.39% of the shares are held by institutions. This has a really low short percentage. Only 0.16% of the shares on float are shorted. There's not too much benefit to short this stock. There's not much room for it to go down lower. And the top shareholders are mainly individuals, probably the people who started the company. 36%, then 18%, then 5.5%. Then Leaping Group owns 5.5% of the stock. This looks like a fund, not an individual. Then another individual owns 4% of the stock. Let's look at the financial ratios. The average PE in the market's 12.5, the median is 15. PE is stock price over earnings per share. To calculate earnings per share, that's net income over shares outstanding. They have negative net income, so they have negative PE. Price to sales is stock price over sales per share. They're at 44.7. So investors are paying about $45 for $1 revenue. This is much worse than the median and average. Price to book is stock price over book value per share. They're at 4.9, so they're at the average. And book value per share is equity over shares outstanding. Equity is assets minus liabilities on the balance sheet, and all their equity is tangible. ROE is net income over equity. They have negative net income, so they have negative ROE. Current ratio is current assets over current liabilities. They're at 9.3, so they have more than enough current assets to cover their current liabilities. And their current assets are $6.5 million of cash, $1.5 million of receivables, and $2.6 million of prepaid assets. So it does look like the company has enough working capital to fund its operations for the next 12 months. But after that, it's going to need more debt unless it brings in more revenue. The only company I looked at in the same industry as ATIF is BGC Partners. And BGC has a better ratio in pretty much every category except debt. They're 64% debt, and ATIF is 0% debt. So to summarize, I do have them trading at a 19% discount, but it's a really risky stock. Anything can happen. They're not really bringing in much revenue, so it's hard to really predict the future. Let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.